Fed decision day in America. In your view, what does getting policy right look like?
I don't know if there's a right answer here. Internally at Apollo, we do not think there's a need for a cut. There's nothing in the data that tells us, but at the same time, I understand the decision. But longer term, I'm not sure it really matters. I mean, if you think about what's happening, the market is ultimately determining the outcome. We have governments around the world who are borrowing record amounts of money. We are, for maybe good and valid reasons, fractionalizing our labor supply through immigration reform. We're fractionalizing our flow of goods through the other tariff and other measures, again, for good and valid reasons. Those things tend to be inflationary. And so a lot of what we're doing is inflationary. Certainly borrowing lots of money has the potential to be inflationary. Depreciating our currency has the tendency to be inflationary. And what we're seeing is a steepening of the yield curve. Rates that matter, the 10-year, are higher, even if short rates are lower.
What do you think the impact will be if we do in fact get another rate cut, and if the Fed does embark on maybe one more next year?
I'm not. This is what's priced into the curve. I think at the end of the day, the short-term fluctuations of monetary policy, interesting but not all that relevant. It's ultimately about maintaining the confidence of the financial system and of the bond market, given the scale of borrowing that we and other Western governments need to do.
It's interesting to hear you say that we don't need another rate cut. Apollo, of course, has access to so many. You own so many amazing businesses all around the world. What are you seeing in terms of the economy? Because GDP has slowed, jobs have slowed. So I think the market wants a rate cut.
Slowed from what?
Yeah.
What's normal? We've gone from a period of time of COVID to massive stimulus to tariff shock. Tell me again what's normal? I don't know that we see normal.
Like 2.5% maybe?
Things feel pretty good. And by the way, growth has been in that range, if not higher, from various points in time. Unemployment is at numbers that historically we used to call full employment. We also have mixed signals. We don't have as many workers, we therefore may not have as many jobs. It appears to me in our companies that things are just fine.
I really enjoyed an op-ed you wrote recently on private markets. You've been beating the drum on this. You gave a really good presentation at Goldman Sachs today on this. What are some things that people are not understanding about private markets here?
Well, I think there are two big things that I've really focused on. First, the definition of private credit. In much of the financial press, private credit means levered lending, a below investment grade deal-related activity. And the reality is most private credit is investment grade. And most of the credit in the financial system that is private, banks, insurers, pension funds, is investment grade. There's a whole discussion about what private investment grade is and why it exists, but its competition is public investment grade. And generally, it has outperformed public investment grade, both in return and in safety. Put that to the side. Much of the press is focused, as I said, on this notion of levered lending. The levered lending, a below investment grade activity, comes in two flavors. One flavor is the broadly syndicated type, which is typically underwritten by banks and then distributed. The other is that which is underwritten by asset managers and is typically held and is sometimes called direct lending. The big miss there is it's just an investment. It's like a stock or a bond. We don't think anything of NVIDIA or the S&P going up or down 10 or 15%. And yet, one private credit loan or one broadly syndicated loan defaults and people lose their mind. Why are people investing in levered lending? They're investing to reduce risk. Generally, what investors are doing is they're taking money out of equity or out of high yield bonds and moving into levered lending. It's roughly the same return, and it is less volatile. And if you hate levered lending, you're really going to hate high yield. And if you hate levered lending, you're really going to hate equity. This is a de-risking activity, and it is mostly conducted by investors who are seeking to de-risk. And I just leave it there. We could go on all day and just talk about private credit.
When we saw some of those, the pressures from Tricolor and First Brands, why do you think that really didn't spill over into the broader stock market? We saw some convulsions, but it wasn't like that worrisome moment.
Why should it be? Companies default all the time. I mean, there's in some of the materials that we will put out later today, you'll see 20 years of defaults in the investment grade market, the levered lending market, And the high yield market, well underwritten credit, even if it defaults, usually has very strong recoveries. The notion that something defaulted, okay, it defaults. The question is, was it a sign of something wrong in the economy? The answer from my point of view is no. This was just sloppy underwriting. In both those instances, the warning signs were there. It was avoidable. And by the way, both were underwritten in the banking system in the form of broadly syndicated loans. Forget that that was not direct lending or asset manager driven direct lending. That was a factoid that people just didn't need.
I love this quote by you at the Goldman today. Great fortunes will be made and lost in data centers. Explain that to us.
Well, we were talking about the notion of financing for data centers. And the point I was making is that as a credit investor, you want to get paid back before you get to renewal. Because it is very clear today and for the next few years that the demand for data is unbelievably strong. Therefore, for the next period of time, based on contracts going in today, we should have very safe cash flows in which to amortize credit. Ultimately, the return on equity, though, is a function of renewal. I have a chart on the wall in my office, which is just about energy usage in the year 2030, not that far away. And each of the good and the great consulting firms have weighed in, and it looks like a child's scattered dart plot. The fact is, if experts looking out not all that far have no idea, we are making a fundamental bet on equity. And that bet is driven by technology, it's driven by chipsets, it's driven by energy usage, it's driven by quantum computing, and a whole host of factors that we are not yet considering. So I think as equity, people should be allowed to take that bet. Great fortunes will be made, great fortunes may be lost. We, in fact, are investors in data center equity under the right circumstances, in the right way, for the reasons that we believe we will get upside. But I don't think it is a foregone conclusion that because you own a data center and you own equity in it, and data is valuable, that you will make money in data center equity.
I didn't want to be that guy to ask you about a bubble. So I'm going to ask it a different way. Are you concerned by how much debt some of these tech companies are taking to fund their AI ambitions?
I'd say concerned, I don't know. And I think tech companies is a broad term. For the most part, the hyperscalers are the largest and most successful companies that exist, not just in the US and worldwide. They have massive amounts of cash flow coming from lots of other businesses. And if I am worried about the debt of hyperscalers, the economy and the US have way bigger issues. So generally, I am not worried. But there's a whole series of intermediaries who are large owners of data capacity, who themselves are not in other businesses that afford them the luxury of using their credit rating and balance sheet to make massive commitments. And those companies essentially are the equity owners of data centers. Levering those companies, given my previous comments, does not seem to be the safest thing I've ever seen.
We'll have to leave it there. No new toys. Is that still the mantra?
Oh, that's old news.
That's old news? Okay.
Our business, in fact, our industry has been going through just massive amounts of change. We've gone from a business that historically had one market, the alts bucket of institutional clients, to now 6 markets. What is needed to serve those 6 markets is different than what was needed to serve just the one. And so we and our peer set are evolving our businesses based on how we each individually see the market developing, and we don't all see it the same way, which is what makes it fun.